Welcome. I'm Alec Hogg, and this is our, inaugural presentation for Easy Equities, the partner of BizNews in this special seminar for you. I think we just need to make sure. Stuart's with me in studio.
Yes, good afternoon all.
Stuart's our managing editor at BizNews, and he's going to be picking up your questions. Can you see, are people connected there, Stuart?
Yes, we've got about 46 at the moment. The question bar is just on the right-hand tab there. You can see, just plug it in there and we'll answer them as they come through.
Yeah, so you got any questions, please do that. This is interactive. I'm going to take you through a presentation, but the idea is stop me when you see anything that doesn't make 100% sense. Stuart will be there to check the questions are coming through. Well, let's get into it. Intrinsic value is a big word, and it's quite a complicated subject. So I'm going to unpack it for you in a way that we can all understand. But I'll also give you the feeling that there are various ways of trying to work out what Berkshire Hathaway, which is today the 5th biggest company by market cap in the world, $350 billion US. Charlie Munger, the deputy chairman, they've been running it for 51 years. But just getting back to Benjamin Graham for a minute, there are 2 secrets to investing that you can read in his book, The Intelligent Investor, the one book that Buffett says you should read before anything else to do with investing. And those 2 secrets are quite simple to understand. The first one is to have a margin of safety before you buy a share. And the second one is to understand this fellow called Mr. Market. Now, starting with the second one first, Mr. Market is the guy who determines the share price on a daily basis. If you buy a house, nobody tells you that, well, your street is a bit cleaner today, so your house is worth 50 Rand more. But in the share market, there are people trading all the time, and they will make the company's value different on a daily basis, which of course it really isn't, but that's the way that markets operate. So he says, does Graham, understand that that share price is there, the recording of the share price is there to serve you, you aren't there to serve it. So when Mr. Market gets terribly enthusiastic, as he does from time to time, we saw it in 1987, 1969, and in various stocks on a daily basis, then the price or the value of that individual asset will be excessive, too high, you don't buy. That's not the time to buy. You wait for Mr. Market to get depressed, for the price to get very low, that's the time you buy. But how do you know if the price is high or the price is low? Well, that is determined by intrinsic value, which we'll tell you in a moment. The second point, though, about the other secret to investing is to make sure that once you've worked out this intrinsic value, once you've got it in your head what the company's actually worth, then give yourself a margin of safety. So we've got Mr. Market, who's volatile, he's a manic depressive who hasn't got any medication, and then once you've established that you can take advantage of his erratic moves, then you have to have this margin of safety, and that means you give yourself a cushion, give yourself a reserve between what the company is worth and where you should be buying. The margin of safety, we like to work on a figure of about 20%. It's a very good cushion. Okay, so off we go to Warren and Charlie Munger. And the way Warren Buffett describes intrinsic value, and remember, this is where it all starts. Whatever share you buy, you need to understand before you make the purchase, what is that company actually worth? There's no point in, if you were buying a house, for instance, and going to a house which is maybe worth 3 million Rand, and because there's a lot of activity in the area, somebody says it's worth 5 million, or they quote it at 5 million, you just accept it. Of course you wouldn't do that. You'd have a look at the real value of that property. Similarly with shares, you need to understand what the shares are worth. Buffett says a share is only worth this, or a company is only worth this. The amount of cash that it can give back to you in your lifetime. So in the lifetime of that company, as it were. So if the company is generating cash back to you, then you can take the value of that cash into today's money terms, and that will give you what is called the intrinsic value. Now, the difficulty comes in here is exactly how does tomorrow's money become worth, what does it become worth today? That brings in something called net present valuing of companies or of those cash flows. It can be a bit complicated. The other thing is, how long is a company going to last for? Is it Buffett says it's the value of that company is the cash flow until Judgment Day. Well, we don't know when Judgment Day is coming. If you're investing in the US, you might think of Judgment Day of 10 years. If you're investing in South Africa, because of higher risk, then maybe you should bring that down to 5 years. But think of it this way. You buy a little company around the corner. That company is generating 10,000 Rand a month in profit, 120,000 Rand in a year. What is it worth to you to pay for that little company? Well, if you're going to be able to acquire it today and sell it in a year's time, if you got, say, if the guy said to you, well, you can buy it for the next year's profits, 120,000 Rand, obviously you'd buy it, because in a year's time you'll be able to sell it on again, what we call the terminal value, the on-sale value, after bringing in the cash flow. And the cash you would have got is 120, sell it for another 120, say, in a year's time, so actually it's worth 240 to you. That's what you'd be prepared to pay for it. If you think that, well, I don't mind holding on to the company for 2 years, then you can get another year's cash flow in it. Of course, that cash flow is going to grow every year, but let's just keep it simple. So then it gets to 360 million it's worth buying the company for. So you understand the concept. It's the cash that you get from the business, and then the terminal value, in other words, what you sell the business for after a period of time. I use 5 years in South Africa to be conservative. I need to know that it is a very, very conservative figure when we're looking at intrinsic value. But the reason we have to have intrinsic value is we need to have a feeling or an understanding of what that company is worth, not to let Mr. Market confuse us. I hope this is all kind of coming through. Are you getting it, Stuart?
Yeah, it's all good, Master. Thanks.
All right. I'm going to start off with the first of these, Wilson Bailey, because it always works better when you use examples. This is the share price of Wilson Bailey Homes Ovcon, to give it its full name. It's the country's leading construction business since 2009. As you can see, it's done pretty much nothing. In the last 7 years, then, what has happened to this company? Well, they've done it terribly well. The profits have grown. The company's base has expanded. And I looked at this and thought, well, what is the intrinsic value of WBHO? Was it overpriced in 2009 so that the share price hasn't moved at all? Or is it underpriced today? And are there other issues that might have come to play? Remember, there was the Competition Commission hearing where the construction companies were forced to pay quite big fines, even though in this case, I think it was about 5,000 contracts that WBHO had where someone in the business had been naughty on 6 of them. So it just shows you it was more of an outlier than a problem within the business. But this is the way I worked through it. I took some assumptions. Now we're trying to get to Warren Buffett's approach of cash flow. And he starts off with a thing called free cash flow. And without confusing you too much, you can pick this up in the income statement, or best to work from an annual report. Remember, you don't have to do this on a daily basis. You can do your analysis on a company once you see the annual report, and just look at it down the bottom. You'll see there at the bottom it says free cash flow calculation. So we take the net income in the company, in other words, the profit after tax. We add back depreciation. Now, what this is, we add back the book entries, if you like. So if you're running a company, you get profit, which is your pre-tax, your after-tax profit. You've paid the government and you've paid your employees and you've paid all your suppliers. In Wilson Bailey's case, it was 513 million, was what they made in 2015. Then you add back the book values, which have reduced the profit, and that's 296 million. What that means, really, depreciation and amortization, it means if you make a capital investment, you can write it off over a period of time, over a number of years. Like if you were to buy a car and you had your own business, you can't write off the total purchase of the car in year one. You've got to do it over the lifetime of that asset. Companies do the same thing. But you've already spent the cash. The cash is gone. And where does that cash go? Well, there it is, capital expenditure. So you would then reduce, because if you've got a cash amount that comes from profits, you write back the book entries, but then you've got to take into account what you're spending on capital expenditure to remain competitive. And that's exactly how you work out the free cash flow, because after that, it'll tell you how much cash you've got that you can actually manage, or that you have got to apply and to allocate. And there it is. In Wilson Bailey's case, 482 million. I put that into the top there. I anticipate that this company will grow at 10% a year. which is not unrealistic because they've grown much faster than that in the past. Then I discount the future cash flows by a figure. Now, a lot of these things, you can think, if you think the company is going to grow fast, you can put 15 in there. Or you think it's going to grow slow, you can put 5 in there. But then I discount it back. In my case, I use 7.8% because that's the long-term growth of companies on the JSE, 7.8%. So I will discount that money back, basically to say that if Wilson Bailey can't grow faster than 7.8%, why am I buying it? I can just buy the ETF, buy the Satrix 40. So I'm bringing that back to today's terms. Then you put that into this calculation here. It starts off at 482, as you can see from the top. Then you add 10% less 7.8, add 10% less 7.8, down to the bottom. And in year 5, remember, we're not going to year 10 as you would internationally because we're trying to be conservative. In year 5, we're sitting at a number of 526 million. That will be the value at which you work out your terminal value. In other words, you're going to sell the business on in year 5. And that brings you here to this one. NPV year 5 times 12, terminal value, 6 billion rand. NPVs of all 5 years, that's the cash flows in all 5 years, because you're going to hold this for 5 years, 2.5 billion. And then how much cash is on the balance sheet of this company today? Because clearly that cash is not disappearing. That's also what you own. And there it is, nearly 4 billion. You put it together, you've got an intrinsic value, in this case, of 12.8 billion rand. Then you divide it by the number of shares in issue, 63 million here, and it gives you an intrinsic value per share of 203 rand. Sounds complicated, but if you work through each of the steps one by one, you can actually work on this net present value quite comfortably to get yourself to a position. So we're saying, Wilson Bailey, our intrinsic value is around about 200 rand a share. Remember, you must go with a range. Don't say it's 203 rand 22 cents and I'll buy the shares up to that point. No. I might be out in my calculations. I might not grow at 10%. The discount rate might be lower than that or higher than that. So you need a bit of a range. So in this case, I'd go with a range of, say, 180 to 220, just to keep yourself really comfortable. But I know that that's what the business is worth through my own homework that I've done. And as Warren Buffett says, if someone walks through the room, you don't have to know that they're 315 pounds exactly to know they're fat. And in this case, is that a fat pitch? Is that a good opportunity? Worth 180 rand minimum, maybe to 220 maximum. Well, when you look back at the share price, this is a company that's trading today at 114 rand a share. Of course, it's good value. So you see where we started on this. We had to look back over the period. It's fairly predictable cash flows that you can get from a big business like Wilson Bailey. The company's share price hasn't moved anywhere in 6 years. I would assert that the reason for that, having done my homework here, is that Mr. Market has got all depressed, whereas the intrinsic value of this company is around 200 rand, as you can see in the figure there. He's only pricing it at 114 today. That's the kind of company I like to buy. Would you be paying 200 rand a share for the company? Of course not. We need the margin of safety. So you bring that in, you take another 20% off it, take it on 160 rand. Still, there's a very nice fat margin between the current share price of 114 and 160 rand. And what do? You don't buy it today at 114 and think you're going to sell it tomorrow at 160. You buy it today at 114 and you hold.
Alec, just a quick question from Sadir. He asked if you can please explain the discount rate again quickly.
Okay, very quickly, the discount rate. Sadir, what we're saying here is that your company, in this case Wilson Bailey, is this year generated 482 million rand in free cash. Next year, 493 million, then 504 million, then 515 as a present value in today's money terms. If you take the actual figure, of course, it's going to be higher than that because you've got inflation that comes into account as well. So I'm using 7.8% as a discount rate to take away inflation because 100 rand that you have today is not the same as 100 rand tomorrow. Next year's 100 rand is going to be worth less because you've got inflation. We all know that. So it's just a way to discount the future cash, to discount the money you're going to get in future back to what it's actually worth today. Because remember, when you're buying a share, you're using 2016 money, but you're going to be getting cash from that share in 2020 terms. And you can't say 2020 money is the same as 2016 money. It's going to be worth less.
Yeah, makes sense.
You
Alec.
get it?
Yeah. Just quickly, Alex, Steve wants to go back to the terminal value calculation.
Steve, terminal value is simply you buying a company. Remember, when you invest in shares, it's all about buying the company. Think of it as buying the company. Of course, we buy a very small little slice of it, but imagine you're buying the whole company. So you're buying the whole company today, Wilson Bailey, and you then have to try and work out what it's going to be worth at some point in future. So we then presume, hopefully you're going to hold the company forever, but we presume that you're going to sell it at some point in future because we're working on the cash that you get into your hand plus this terminal value, in other words, what you sell it on for. That's the value of a company. You can't just work on the cash flow. You can't say, well, okay, this company is going to generate cash from here to Judgment Day of whatever it is, because we don't know when Judgment Day is. So we've got to take we've got to take an estimate of when Judgment Day is going to be. And I hope there aren't any people who are going to hold me to this. And in 5 years' time, it's all going to happen. It's just a term of speech, really, that I'm trying to use here. But in a South African sense, I like to use 5 years. Clearly, if you use 10 years, then your valuations would go up significantly because you've got an extra 5 years of cash flow plus the terminal value will be much higher after 10 years than it will be after 5 years if the company keeps growing, which we presume. We're doing our homework and buying the right ones. So it's a way of saying, this is the cash I'm going to get in the next 5 years. Then I'm going to sell the company in 5 years' time, and that's what I would get in cash there. So there are three things that make up the value in this model of the value of a share. The one is the cash flow you get in the next 5 years, using a South African conservative sense. The other one is the cash that's already in the company, and in this case, nearly 4 billion rand they're sitting on. And the third one is, what would you sell the company for in 5 years' time? I hope that makes a bit more sense. Sure.
Yeah, just a follow-up from Steve. He asked why NPV times 12.
Oh, because, good point. When you get to the terminal value, so in other words, you get to 5 years' time, you're going to sell that on a multiple which is reasonable. When you buy a share on the JSE, you pay a multiple of the current earnings or of the cash flow. What we're saying is that you'd be happy to buy, someone else would be happy to buy this company at 12 years cash flow when you sell it on. Although we're working on a 5-year period to keep it nice and conservative, you look at the average PE on the JSE is about somewhere between 15 and 18, depending on which stock you're talking about. So and that means you're buying 15 years future profits. We're getting even more conservative. We're saying you're buying 12 years future profits. So what I've tried to do here, you'll see all along, is keep it conservative. I've done about 50 in preparation for this webinar. About 50 companies. I looked at their intrinsic values, and I only came up with a handful that were worth acquiring at this stage. Remember, I don't play at all in the resources field. I don't believe that resources are investments. I knew quite a lot about horse racing. In fact, I even bred horses at one stage. And if you're going to go and buy a resources stock, my suggestion is rather go to Turfentine. There's quite a good ratio between number 6 in race 4 and number 4 in race 6 coming home. So you can go and play on those kind of odds. When you're buying a commodity, you are taking away your great advantage of investing in shares. Investing in shares is leveraging human ingenuity. The management of a company should be taking a certain amount of resources, bad word, should be taking a certain amount of assets and leveraging them and making them produce a better return for you. If you're buying a resources company, all you're doing is you're buying an inanimate, dumb object, be it gold, be it chrome, platinum, whatever, and hoping that at some point in time you can sell that inanimate mineral to a greater fool and hoping it doesn't go down. So that's really what I did. And I went through about 50 of these companies and came up with a handful of them because the market's not, Mr. Market is real dumb. I mean, he's real crazy. He's manic depressive. But from time to time, these shares do get out of kilter with the intrinsic value, and sometimes they're a lot lower. Your secret is to buy them when they're lower. And these are the ones I'm focusing on today.
Just quickly on the discount rate, so just we understand what it is now, but he says why 7.8?
I use that one, Sadir, because that is the 100-year return on JSE shares. So if you take the last 100 years, on average, your growth would be 7.8%. You can use any kind of figure you want to. You can take an estimate of the inflation rate if you like. I just believe that that's the best one, because if you can't, if Wilson Bailey is not going to be attractive at a 7.8% discount rate, then you must just rather buy Satrix 40, because that'll give you 7.8% over the long term. It's important. Please remember, investing is very, very different to trading. Investing is you buy the shares, you hold on forever, or until Mr. Market goes silly, as he does sometimes.
Pakadi just wants to check, so if a company issues or buys back its shares, the intrinsic value changes, obviously.
Yes, it does. And that's a very important point, because when companies buy back their shares, you have to check that they're buying it back below intrinsic value. Sometimes some executives are very naughty. They will be buying back shares in the company to boost the share price because they've got share options coming up. You have got to assess, is this a company that actually knows what it's doing? If it's buying back its shares at below intrinsic value, it's adding value to the shareholders overall. Warren Buffett's very big on this. His four big stocks, remember he's got a portfolio of about $120 billion. Four stocks make up about 2/3 of it. And of those four stocks, they all buy back their own shares. IBM, Coca-Cola, Wells Fargo, and American Express, because they're buying back the shares at a lower rate in his mind. He's worked out his intrinsic values, and he says it's good that they're buying back shares because they're doing it below intrinsic value. And if that happens, then the company is applying its cash, the way Buffett says, is it's buying dollar bills for less than $1. There's no better investment that you can make as a company. My own experience, I listed MoneyWeb in 1999. People all over me wanted shares. We issued the stock at a rand. A couple of years later, those shares were trading at 17 cents. What did I do? I had quite a lot of cash in the business. We bought back shares at 17 cents. That's a good deal. And we did that a few times through the history of that little company. It's easy in a little company. There's always the concern, though, that you're actually buying out your partners. And I was never really comfortable about buying out partners in the business. But if they really wanted to sell their shares, well, I guess that was their story.
From the rest, Alec, a claim from Sanral, does the effect of the market price of Wilson Bailey Homes?
Claim from Sanral? No, he's got the wrong company. It's another one.
I think they're looking for fines across the border on the roads issue, the damage to roads.
I'm not sure. And I think that's, I really don't know any of that. I think that you've got to look past the immediate short-term noise. I did see that Sanral were claiming. Are you sure it was?
It's more than one.
Is it more than one?
Yeah.
Okay. Well, those are issues that you need to then assess in it. But I think we've got a big enough margin of safety here. Remember, Wilson Bailey is an interesting point. Gets about half of its revenues from Australia now. So you actually got a lovely rand hedge there as well. Here's another one, Blue Label. Last year, after the Berkshire Hathaway AGM, I spoke to the group of people at Standard Bank and said to them, Blue Label looked just unbelievably cheap at the time. It was R7.50, and this goes back to when Blue Label was listed in 2007. You can see there, on the first day it listed, it got to $8, and a year ago it was trading at this level. Well, all of a sudden, in the last year, the shares have really caught fire. Belatedly, took them nearly 10 years for people to understand the value of this business. But I looked at it again and thought, I do remember that Blue Label was a very, it's got a sound business model. They've got a lovely moat. It's hard for other people to replicate what they've got there. Now that it's gone up to $16, is it still value? So I did the intrinsic value calculation. And here I've been extremely conservative again. There we go, with a growth rate of 10%, a discount rate of 7.8. This company generates free cash flow of about R1 billion a year. They sell airtime and prepaid electricity, etc., in South Africa, Mexico, and India. expanding rapidly in Mexico and India. So they've got more than 300,000 distribution outlets, lots of little transactions, very small margins. And I worked on their R1 billion free cash flow and my 10% growth rate with that discount rate, and saw what would happen to this company. Where did it come out? And there it is. You can see the intrinsic value per share, 29.35. So although Blue Label has done very well in the shares, or its share price has risen strongly in the past year, it's still at a lovely discount to its intrinsic value, in my opinion. I'd be very happy to buy it at this level. In fact, very happy to buy it right up until probably 22 Rand a share, at which point it's your margin of safety is now starting to get a little bit tight. I hope that kind of understands. And you can do these calculations yourself on many stocks. Another one I did was Imperial. It came out really nicely. There's the Imperial story since 1994. It's a 20-year story. Wouldn't it be nice to have been bought it around there? And of course, there the share price went up and it's come back again. I know the chief executive, the new chief executive, Mark Lamberti, quite well. I've got a very high regard for him. I've seen the Imperial operations internationally, and am most impressed by the way that they can compete with the Germans in logistics. My goodness, if anyone can compete with the Germans in that, in fact, they're the market leader in Germany, then you've got to be doing something right. So I did the intrinsic value calculation there again. On this one, they generate free cash flow of just over 2 billion Rand a year. Again, using a 10% conservative growth rate, particularly if you've got big international interests, the way the Rand's going, that's very conservative. And then a discount of 7.8. Put the numbers in, there they come out. You have a 40 billion Rand intrinsic value on the share, or 199 Rand per Imperial share. That's my calculation. I go back to where the share price is, and if it's trading at 145 Rand, where it is at the moment, you've got a nice margin of safety. So first of all, you've got to like the business. You've got to like the business model. You've got to believe that they've got a good moat, that the business is going to be around for a long time. You don't want to buy into something where it's going to fall over next week. It's a good, solid company, good brand. Then you work out the intrinsic value to tell you what is it worth today. Clearly, at 220 Rand a couple of years ago, you'd be paying over the intrinsic value and let Mr. Market do that. But today at 145, it's a good long-term holding, remembering that you're going to hold these shares forever.
Just quickly from Robert DeFoss, he said he missed the NPV definition.
NPV, that is, Robert, it's taking your cash that you get into the future and discounting it into today's money. So in very simple terms, 100 Rand today, or 100 Rand note today is worth more than its 100 Rand note will be worth this time next year in your buying power because of inflation. So it's to get next year and the following year's 100 Rand notes and to work out what are they worth in today's money terms. I hope that makes sense. So we've done, this is the most simple one. This is the one that you go and play around with. Start doing it on your whole portfolio. The best thing about investing is to understand where you are and why you are doing certain things. And once you start playing around with these numbers, you get better at it all the time. Nobody's an expert. Even Buffett gets it wrong sometimes. But over his 50 years, his intrinsic value calculations, I can assure you, are pretty sophisticated. And remember, this is the greatest game on earth because it changes. Conditions, circumstances change. Read those annual reports. Have a look at what the companies are doing. And then you can work that intrinsic value out. I'm going to give you, there's another way, though, on valuing a share, which is a lot more difficult. And this is a concept that is only now starting to be understood. As human beings, we think in linear basis. We think, well, we're going to have one child this year, maybe another child in 2 years' time. It's very hard for us to think what happens to those children and their children, etc. So for each child that you, say, fathering today, their generations in 100 years' time, they might have 50 people who come from them. Well, if they've got maybe more wives, of course, it'll be more than 50 people. But it's called exponentiality. And exponentiality is something that human beings really battle with. Moore's law, you might have heard of. How Moore's law works, and it was interpreted by Gordon Moore back in 1964. He was at Intel, And what he said was the way that things are developing at Intel, where they made silicon chips for computers, was that every year, or year to 18 months, we will be able to produce something that has got double the capacity, double the power for the same price. And when you start putting that into your spreadsheets, the numbers become scary. This is the share price graph of a beneficiary of exponentiality called Amazon.com. As you can see, going right back to when it was in the mid-90s, when it was founded, it initially didn't do a whole lot on the stock market. Then it had that run up in the dot-com boom. Then the dot-com bust. It went down to where it was 10 years before, and slowly started building up again. And during all of this period, Wall Street looked at Amazon and said, you don't know what Jeff Bezos, you don't really know what you're doing because you're not making any profits. Well, if you understood the Amazon story, and it's a little bit like Blue Label, by the way, similar kind of thing. We're investing heavily in infrastructure, not worrying too much about the profits, building for the next generation, building for the next year. What Amazon has done is it's transformed retailing in the world. And indeed, that started catching on around about 2010, where the smart investors got into it. Now the not so smart investors are starting to jump onto the bandwagon as well and realize, my goodness, this is a phenomenon. And it was assisted in the last couple of weeks by Warren Buffett. That is where the share price was. The share price was about $650 a share before the Berkshire Hathaway AGM. It's now $717 a share. It's a big jump, 6%. Because at the Berkshire AGM, that, by the way, is a picture of Jeff Bezos, the guy who started Berkshire Hathaway. At the Berkshire Hathaway AGM, on numerous occasions, Warren Buffett and Charlie Munger referred to Amazon.com. That they spoke about the Amazon effect, how Amazon has transformed retailing and e-commerce, how Walmart came to some of the Berkshire subsidiaries and said to them, look, we're struggling because of Amazon. Remember, Walmart is the biggest retailer in the United States, huge company, but they are starting to have their lunch eaten by Amazon. So they went to Berkshire subsidiaries and said, we need you to pay us quicker, and we will pay you over less time. So, in other words, improving their cash flow because they're struggling. Now, when you get that kind of a conversation going at Berkshire Hathaway, where 40,000 people go to Omaha to listen to what Warren Buffett has to say, it's similar to a conversation he made a few years ago about Google, where he said, although he's not investing in Google because he can't work out the intrinsic value, he does think that their business model is impossible to break. And his best friend is Bill Gates, who clearly is at risk with Google. The Google share price then started running because value investors bought into that story. They're doing the same here. He mentioned that we can't out Bezos Jeff Bezos. And at another discussion point, he said that the value of Jeff Bezos to Amazon is priceless. Those are the issues that start coming to play in exponentiality. And we have a South African example of this in Naspers. This goes back 20 years, or just over 20 years. You can see the Naspers share did pretty much nothing for half of that period. And then what happened in the late 90s was that this man, Koos Becker, decided to do something very different. He saw that the future of media in South Africa was maybe not that good. He did start MWeb and get into the internet field, but he felt that there were bigger opportunities if he went global. So he and the late Antoine Roux had a strategy that they called throwing mud at the wall. And essentially what then was go and look in emerging markets where they could find assets, internet assets, that looked like they could win. Of course, they could never pick the winners. Nobody can at such an early stage. But they bought a company in Russia called Mail.ru, which has done very well. But the spectacular deal was when they acquired 50% of a little Hong Kong company of 30 people called Tencent. They paid about $30 million for it at the time. It's worth 100 times that today. And so is the Naspers share price, because that investment in Tencent has been a phenomenal success. And the Naspers share price at the moment, as you can see, that exponential growth is due to the exponential growth of Tencent in China. It was an internet company in the biggest, most populous nation on earth, starting off early on, and South African business is the biggest shareholder. It's been called the most spectacular private equity investment in history, and that's why the Naspers share price has done what it has. Some people will look at this and say, my goodness, but it's got to fall. Anything that goes up will go down. And they might be right. But it's not based on what Naspers has done. It's based on Tencent. And Tencent, in an embryonic market like China, has got a preeminent position. In fact, Pony Ma, who is the chief executive of Tencent, is regarded in China as, between him and Jack Ma, the man from Alibaba.com, they're not sure who the greater entrepreneur is, but that's how this is esteem with which he's held. So exponentiality is something never to discount. It's impossible to work an intrinsic value on it. If you find a stock that you believe is going to be growing exponentially into the future, one that I'm doing my work on at the moment is Facebook. Being in the media industry, I get Facebook. I understand what Facebook is doing. I understand the virality of it. And it looks to me like it's unstoppable in the same way as Google's unstoppable. And I guess in China, Tencent is unstoppable, which means Naspers is unstoppable. So I'm doing my work on it now, finding the right time to buy into that stock. If you'd bought Naspers, say, in 2006, around about this level at 1,000 Rand a share, well, you wouldn't believe that it could double again in the next few years. But that's what exponentiality does. So it's very hard to do a valuation of these companies until you can sit down and put it on a spreadsheet and say, well, if it does keep growing at 35% a year, what are the numbers going to look like? Koos Bekker, South Africa's great entrepreneur.
Alec, just a few requests on if it will be available after the webinar.
Yes, we will. We're going to be transcribing the entire webinar. It'll be on BizNews, and I think we're going to put it on the Easy Equities platform as well. So you'll be able to read and listen and watch again at your leisure if you have to rush out now and go and get that hamburger or salad for lunch. Just going to close off with the cigar butts. And this is a big part of the investment strategy that Benjamin Graham began with in the 1930s. What is a cigar butt? Well, as you can see there, this one's probably got one last puff. We used to call it a nip when many years ago when I was a young guy, I used to smoke. What would happen, we didn't have much money, so you'd smoke half the cigarette and then stop it so that you could have you'd have a nip of your cigarette a little bit later. Well, in the 30s, what happened those days were the rich guys, as a status symbol, would smoke these big fat cigars. And wanting to help the less fortunate, they would flick the last bit of the cigar away when there was still at least one puff left. And that became a terminology for shares that have been really bombed out, but have got at least one little uptick in it. I started looking for some cigar puffs and came up with two. I don't know if South Ocean is going to be just a one puff benefit. I think it could be a lot more than that. But here's a 10-year share price graph that shows you it's a company that manufactures electric cables and lighting equipment. So very basic infrastructural related business in South Africa. It's got a problem with the Competition Commission looking into it, but again, that's not going to kill that company. It'll hurt it, but it won't kill it. What will kill it is bad management. And as you can see, this business has had a pretty rough ride over the last 10 years, and indeed since 2012, when it was 2 Rand a share, to its current level of in the 30s. I had a look at the vital stats, and you'd get this from going into the balance sheet and the income statement. In other words, put into Google South Ocean annual report and start reading it. And some very interesting things come through here. They got a chief executive, a new chief executive called Koos Bekker. Not our Koos Bekker or the Naspers Koos Bekker, but this is Koos Bekker, who's a chartered accountant, and he's just taken over from August 2015. That's always a good sign. Then I had a look at the market value of this company. It's 56 million Rand. Remember, buy the company, not the stock. So if you want to buy the whole of South Ocean today, and you had 56 million Rand, and the owners of the shares were prepared to sell it to you, that's what you would be able to buy it for. Would the owners of the shares sell it to you? Very unlikely. because the tangible net asset value, and that is a very important thing. When you're looking at the balance sheet or the financial statements of a company, always look at tangible net asset value, not net asset value, because there can be a lot of goodwill and a lot of nonsense in there. So the tangible net asset value is nearly 10 times what the market value is of the moment. So what that says to you, you can actually buy this company for 56 million, liquidate it, and get yourself 556 million, or 559 to be exact. So that's already telling us that these shares are a little neglected. Then you look at the size of the revenues. Now, if the whole company can be bought for 56 million, the revenues are 1.7 billion a year. Already that says to me, hang on a minute, I don't mind buying those revenues for 56 million. And the net cash that it's generated in the past year was 33.5 million rand. As you go through the notes to the accounts themselves can be very confusing, but look for that number. It says, where's the net cash? Where do they talk about the net cash? So here we are buying a company for 56 million rand when it's giving us cash this year of 33.5. Hopefully the managers know what they're going to do with it. We've got the new Koos Becker there who presumably wants to impress. So he'll take that 33.5 million and allocate it properly. What they did last year was they reduced their overdraft, as you can see there, from 109 million to 74 million. And there is a risk here. There's a Competition Commission investigation into the electrical cables business. But with, at 56 million rand, you're buying a share there, well, I think you're not really doing, you've got a cigar butt that's probably worth a whole lot more than it. So is the share price down where it is reflecting reality? No, it's reflecting disaster. And it's not a business, in my opinion anyway, that is going to hit disaster, not with the cash flows that it's generating. Nice little one for you to go and do your homework on. Another one is ESOR. Look at that share price. $9. That was about 7 years ago. And it's now 29 cents rather. You can pick it up on the market today. So it shows you that this is a company that really has had its share of challenges. So again, I had a look at the vital statistics. They've done quite a lot of changes there. They sold out a big part of the business, the Frankie Powell part of the business. You can see, in fact, on this graph here, where it falls quickly, that was with the sale. They paid quite a big dividend at that time, about 38 million rand. And ESOR is a restructured, as they call it, back to basics business. Cut the headcount in the past year by 20%. That's quite apart from the Frankie Powell getting rid of that. And that's always a good sign. When a company is prepared to button down, do the necessary, take the retrenchments, take it on the nose, and streamline the business for the future. Where the revenues? 1.4 billion rand. Market cap of this company is 115 million. Okay, already I'm getting quite interested, because if they can do things on a 1.4 billion revenue stream, your market value is only 115 million. You're getting yourself quite a nice business. But then you have a look at net current assets. And what this is you take looking at the balance sheet, you take the money that's owed to the business today and the money that it owes. So it's the essentially debtors. We all understand that. People owe you money, the accounts outstanding, as against the accounts you've got to pay. The difference there is about 180 million rand. Then you've got cash of another 36 million rand on top of that, sitting in the balance sheet. And there's odds and sods that carry on. So for a market cap of 115 million, you're getting net current assets. Stop it today, liquidate everything, you get 313 million. Actually, more than that, because when you take all their plant and equipment and property and everything else they own, the tangible net asset value is 584 million. Hello, now I'm interested. How about the cash flows? Well, in the last year, there are a lot of funnies in the figures because there were retrenchments and they got some money in from selling virtual certain things, and they got the working capital down by, well, as you would expect, if you're starting to make the business more efficient, you reduce your working capital. But they generated cash flow last year of 98 million, and that reduced their gearing, in other words, the debt level, to 24%. Don't worry too much about that, excepting if your debt is 24% of your equity, then you're not exactly over-borrowed. It's when you get to 100% plus that you're over-borrowed. So I look at the whole thing and I say to myself, my goodness, this is a stock that is well worth, it's on the recovery path. It's got lots of assets there. It has been around for a long time. It's priced for disaster. Let me read a little bit more about it. And I think this is another cigar, but How far will the cigar butt take you? Maybe to R1, maybe to R2. Who knows? But certainly it's got value in this business that is a whole lot more than the 27 odd cents that it is trading at the moment.
Alex, just a quick point from Orestes. It says South Ocean's up 38% in 2 days, granted on low volumes.
Well, stop it. Then don't get crazy. You know what's happened was I did a roadshow with post Warren Buffett, and clearly some people have now thought exactly what I told them not to do. I said, don't go and buy the share. Please do your homework. Understand what is going on in this business. Just don't rush into it now. Just sit fast. Hold a little while. It's still value at that level. But what tends to happen in these cases is that somebody decides to share tip, and they rush in hoping that they can sell the stock to a greater fool. You don't have to buy anything. You take your time, you identify opportunities, and really this is just to show you an opportunity that is possible. It's not to say to you, go and buy the stock. What you now know is these are the things to look for. Please don't go rushing into this as a share that you can add to your portfolio. Or maybe take a small little slice of it. It's still, if it's gone up 38%, that means that the market cap would have then gone to, say, 80 million, 90 million. Tangible net AV of 550. I can still live with that. I think you can too. That's my story for today. I know we've gone over a little more than the half hour that we anticipated, but I guess this is quite a complicated subject, and it's a lovely basis from which to start understanding investing. And investing's easy. It really is easy, and Easy Equities makes it even easier because they make it really cheap. So to do the investing. So these are kind of the ground rules. Read that book of Benjamin Graham's. Read my book on Buffett as well. And I know if you're with Easy and you've done your featuring, you'll be able to get. We're sending it to quite a few people in the email. And just read the book, understand it better, and it'll give you those basics, because this is the greatest. It's the greatest game. That's the greatest game. When you understand equities, and you can buy them, make long-term investments for low costs, and just leave them there. Don't trade them. You always will be a winner. Well, thank you for being with us, Stuart. Thanks for fielding those questions. And we will have everything on. It'll be transcribed. We'll get the presentation onto the BizNews site, also onto the Easy sites. If there's no more questions, Stuart?
No, that's it. It's all good this side.
All quiet. Okay, great. Glad we could answer all of those. There's our contact details, Facebook, Twitter, LinkedIn, or you can always drop me an email. It's been a privilege to be with you today. We've had a good turnout of people live, and I hope if you are accessing this after the event, you also find that it's been worthwhile. Thank you.